Good afternoon. I'm George Pember. I'm an attorney in Northborough, and I'm here at the request of the Mass Bar Association to give a presentation on trusts and how they might impact you. I want to make it as personal as possible so that I want each of you to feel free to ask me any questions or bring up some comments that you have that will shed some light that everybody else can benefit from. First, I will ask a basic question. Has anyone here had their last will and testament either reviewed or they've signed a new one within the last 5 years?
No.
And then let me ask, has anyone here had it done in the last 10 years?
Yeah, well, is it about 10?
10 or 15.
Yeah.
Yep.
All right, so it's a while. Okay. So I'm going to get off topic for just 1 second, just to suggest to you that one of the most important things you can do is to have a durable power of attorney. And a durable power of attorney is something that enables you to enable someone else to handle your finances in the event that you can't do it yourself. And I don't know if it was explained. I assume you have one, but if you don't, let me explain that I've seen situations where the wife has a sudden stroke. She really can't communicate very well. The husband decides that now that my wife has had her stroke, there's no way that I want the way that she's allocated the investments that she has, like her 401k or her IRA. There's no way I want that invested the way she did. So I'll just call up. And he calls up the administrator for the 401k and says, let's change that around. And the administrator says, well, who are you? Well, I'm the husband. So what? What's your legal authority? Well, I'm the husband. It doesn't work. You have to have a power of attorney. So even with a husband-wife situation, it's critical. If you are a widow or widower or a single person, very important that you have someone appointed as your power of attorney. So if you do get sick, that person will have their authority. The point that I want to make on this, and that's why I asked the question, is how recent is the estate planning that you've done? I have run into a couple of situations where my client was told, I'm sorry, your power of attorney is too old, we can't honor it. And there is no such thing as a too old power of attorney. But there are institutions that say, yeah, yours is too old, and then we will not honor it. How old is too old? Maybe 10 years. So if you haven't done anything in 10 years, you might want to think about updating your power of attorney, just for what it's worth. And then real quick, the other thing that you need to help while you are alive is your healthcare proxy. And I'm guessing that everyone here has a healthcare proxy and has given a copy of that to their primary care physician.
Yes.
So I think that everybody should be all set on that. If not, then that requires, again, attention right away. Now, we're going to talk about trusts, and for the most part, people who are doing trusts are people who are planning not for while they're alive, but while they're dead. But that's a myth, because it's very useful to have a trust while you're alive. And I'll go to my own personal situation. My dad set up a trust, and he put all of his investments in the trust. And when he sold his house, the money went into the trust. And he named me as the trustee. My dad was a very, very sharp character. He was very smart. And he knew what he was doing in handling his money. And he could have just had it in his own individual name and just handled it perfectly. But he put it in a trust. And I was the trustee, so I had to sign everything. But it soon became apparent to his advisor, his investment advisor, that if Dad said do X, I was telling her, let's do X. And if Dad said do Y, let's do Y. And with my permission, she started going right to Dad and saying, all right, what do you want to do? And Dad would direct her, and she would do it, and I would rubber stamp it, or sometimes she wouldn't even come back to get my permission. But I looked at the statements, and I could see what he was doing, and I approved of it. And if I didn't, he and I would have a discussion, and we talked about it. Well, Dad lost his vision. And although he remained very sharp, he could no longer read stuff, he couldn't follow what was going on with his investments. And he told me, hey, you're the trustee, take over and run it, which I did. It was smooth and seamless. We didn't have to do any additional paperwork. Nobody was challenging a durable power of attorney because it was too old. It was right there. It was in the trust. I was the trustee. Bang, I could do it. It was great. So why would you do a trust? Well, now I'm thinking down the road a piece. A lot of people want to do a trust because they've heard stories about legal fees and how outrageous legal fees are, and you can avoid the legal fees of settling an estate if you have money in a trust. There could be some truth, Ruben. I've seen situations, and I like to tell stories, so here's another one for you. A client came to me one time and said, geez, I need some help. My sister just died, and I'm named as a co-executor on her estate. Could you help me settle the estate? And I said, oh, of course, I'd be happy to. You're a good client of mine. Where did she die? Oh, she died in Alabama. Oh, I'm sorry, I'm licensed to practice in Massachusetts, but I'm not licensed to practice in Alabama. I would not be comfortable doing that work in Alabama. I think you need to hire an Alabama attorney. Well, I don't know where to turn. I said, well, did she have a last will and testament? Yes. Well, then why don't you go to the attorney who was handling that? And so she did, and she asked him if he could do it, and he agreed to do it. And it was a complex situation, very, very complex situation. The woman had her personal residence in Alabama. She had a summer home in New Hampshire. And she was originally from Northborough, which is where I lived. And so she had property in Northborough, which was a multifamily building. There are very few in Northborough. This is one of them. And it was in atrocious shape. And it was 50% owned by someone that no one has seen or heard from in 20 years. Well, I spent a lot of time on that file, an awful lot of time on that file. If something came from Alabama for signature, it came to me, and I reviewed it and explained it to my client, and then she signed it, and I shipped it back to Alabama. If something had to be done in New Hampshire, that came to me, and I reviewed it and explained it to my client, and that's how we handled everything. With the house itself, it was in such bad shape. Literally, the sides of the house started to bow out. And the building inspector looked at that and was on the verge of condemning the building. So what we had to do is we had to hire a company to come in and jack up the house and reframe some of the structure in order to make it safe. And then we had, of course, some tenant issues. People didn't want to pay their rent, and so we had to deal with that. Bottom line is, we had to set up an ancillary administration in New Hampshire and sell the property in New Hampshire. That attorney charged about $800, which is pretty reasonable. I charged about $5,000. Now, this is many years ago, but I charged about $5,000, which for supervising 2 estates, dealing with an unknown owner and tenant problems and building problems, there's a lot of time I'd spent. So my client called me one day and she said, geez, I just got the bill from the attorney and I don't know what to do with it. And I said, well, what's the problem? She says, well, it's a little more than I expected. I said, okay, well, how much is it? Well, it's $50,000. I said, 50,000? Are you sure it's not 5,000? No, it's 50,000. I said, wow. Well, I know that the attorney had to sell your sister's house. Yes. And I know she had a couple of bank accounts there. Her investments, they're considered to be Alabama assets, but they're pretty simple to close those out. Did the final tax return. I said, let me call him. And I called the attorney and I said to him, do you have time slips? Do you keep time slips on the work you do? He said, oh, heck no. He said, I don't do that. He said, I charge a percentage of the assets. My bill is 5% of the assets. She had $1 million worth of assets in this state. My bill was $50,000. Simple. No question about it. I said, really? Wow. So if you have an attorney who's settling the estate, you want to avoid that like the bubonic plague. Well, for those few attorneys who are still charging that way, when it's in a trust, they don't charge that way. Only in an estate do they charge that way. So it's well worth it to avoid legal fees if you're in an area of the country where attorneys are still charging on a percentage of assets and not on an hourly basis or a small flat fee or something like that. That's worth it. But that's not typical in Massachusetts. I'd say it's extremely rare these days that attorneys charge that way. Almost all attorneys that I'm aware of bill their time. And if they spend a lot of time, you spend a fair amount in legal fees. If they spend next to nothing, you get charged next to nothing. So I don't think that's a good reason to, quote, avoid probate, which a trust does. However, using a trust is a fast way to settle things. And the kids will thank you immensely if you put everything in a trust. I mean, of course, you won't hear it because you're 6 feet down, but it benefits them greatly. Assets in a trust can be distributed almost immediately after death unless you're aware of the fact that there's a lot of outstanding debts. If there are outstanding debts and no money in the, quote, estate to pay them, then you have to hang on to the money in the trust. But if you're not aware of that, you don't have to hang on to it. Whereas, when you have an estate, claims can be made against an estate for 1 year up to the date of death. So you take a chance if you distribute the assets in an estate, and then lo and behold, 11 and a half months into the mission, someone pops up and says, hey, Mary owed me some money. She personally guaranteed some obligation, and I want to be repaid. If you've distributed the money, how do you claim it back? If the people to whom you gave the money have paid off their MasterCard and their Visa and their American Express and their Discover card and their car loan and their student loans and their mortgage, and you say, I need the money back, good luck. So a prudent person who's settling an estate has to wait 1 year. If the money's in a trust, you don't have to wait that long. You can distribute it quickly. The other thing is that if assets are in a trust, the trust is not a public document. Your last will and testament gets filed with the Registry of Probate, and anybody can look at that. But the trust is a private document, and no one looks at that except the trustee, the person who's in charge, and maybe an attorney who's helping you settle things. That's it. So you get privacy and you get speed by using a trust.
So can I ask a question?
Absolutely.
So the will, you don't have to have a separate will and have a trust. The trust, the will, what you want to put in the will can be in the trust. Is
Yes.
that true?
Yes. So if you have 3 children and one is the black sheep in the family.
We do, but we don't have a black sheep.
Oh, well, suppose you have. So you have a black sheep and 2 kids who love you, adore you, can't do enough for you, and you want to divide everything 2 ways and not 3 ways. If you put it in your last will and testament, and that's a public record, everybody reads it. Or anybody who's interested, like the black sheep, everybody can read it. If you put it in a trust, Nobody knows what you did with your assets.
But we don't have that situation, thankfully, I'm happy to say. But how does, let's say you did have that situation, how does that third person, that black sheep as you call them, do they just have to take somebody's word that that's what the assets were?
If they,
How are they satisfied that that is what's really happening?
if they put up a stake or threaten a lawsuit or something, you can share with them the trust. You're still not sharing with your neighbors or your coworkers or your friends. It's just with them, and they can see it in black and
But
white.
the trustee doesn't have to share with anyone,
Right.
if they really choose to.
Just the named beneficiaries, they
I
have
see.
to be notified.
I see.
But if someone says, I'm going to sue you because I should get a third of mom and dad's assets, even though I'm the black sheep, I'm still their offspring, and I want a third of their assets, then you have to share it. But you'll have language in there, if it's properly drafted, that says, I have intentionally omitted my black sheep son or daughter from taking anything under the terms of this trust. It couldn't be any clearer. In my case, I also do an affidavit if someone isn't going to split it equally among the kids. And I put in there, I've chosen, Mary and Tom told me that they've chosen not to give, and I'm typing ways I say this, not to give any assets to the black sheep in the family because they haven't had any communication with that child in over 10 years. And the last communication was a rip-roaring accident. And there's no Mother's Day cards, no Father's Day cards, no birthday cards, no Christmas or Hanukkah holiday cards, nothing. No, and we send the card out on their birthday, we don't get any response. So parents have chosen not to share anything with the child, and it's, I've documented it, plus I put that language right in the trust. You still need a last will and testament. Even if you have a trust and you've successfully moved your assets into a trust, you still need a will. Well, why? The reason you need a will is because there could be an asset that you thought you moved into the trust, but you didn't do it properly. Or there's an asset you forgot about. Or there's an asset that you didn't know about. Your Aunt Marie, single lady, didn't have any kids. When she died, she named you as the beneficiary. You're dead, but it goes to your estate. Well, you better have a will to figure out where it goes. Or you can be like a client of mine who went to the hospital one night and complained about pains in his shoulder and chest. And the doctor said to him, have you had any spicy food lately? And he said, yeah, I had Mexican food for lunch. And he said, that's it. We're going to give you an antacid. You're going to take a couple of antacids. You're going to go home. You're going to sleep. Get a good night's sleep tonight. And if you still feel crummy tomorrow morning, give me a call. He died that night from a heart attack. He was having a heart attack and the doctor didn't diagnose it. We sued his estate. That was a pretty good sized settlement. It was payable to his estate. Well, if you don't have a will, who gets it? It goes by the laws of intestacy, which the state makes up. If you want to do something other than, quote, routine, you should have a last will and testament. To direct it into your trust where you have specific directions as to who gets it.
So if the will, if I may ask another question, so if the will is in the trust, it's also not public?
The will is not in the trust. They are two totally separate
So the will
documents.
is public?
The will is always public, but your will could be what we call a vanilla will. And the will just says, I give everything to my trust.
I see. And then you divide, you do what you want in the trust, and
Exactly.
that takes care of that.
Exactly.
And while a couple other questions. So
Sure.
the healthcare proxy and the power of attorney, the durable power of attorney,
Yep.
that's outside of the trust. Is that
Yes,
true? Those are separate documents for those specific purposes outside of the trust?
That's correct, yes.
Okay.
Yep. Okay.
I want to, if I while I'm on a roll here, if I
Sure.
may.
Let her rip.
So, I mean, without getting too specific, we have this will and we have a healthcare proxy and do a power of attorney that we did some years ago. It's got to be at least 10 years, probably longer. So that's why we're here, is we have to update those because things are more settled in our family with grandchildren and things like that. And it's getting time for us to think about how to do that as well as what we want to do.
Yep.
And I read that trusts are more popular for a variety of reasons. And the main question that I have is the advantages, and I know you've talked about some of the advantages of having a trust and how does it work with property, with other monetary assets, investments? How does that all work? And what is the advantage of that?
Okay.
That's one of my questions.
Okay, good.
If I may.
Yep. Okay. One other quick point, and that's if you did your estate planning more than, say, 10, 15 years ago, a lot of us have now incorporated reference to what are called digital assets into the documentation. If you're someone who gets a paper statement from your bank every month, that's not relevant. But if you're someone who gets your statement every month on your computer screen and you're deceased, how do I access your information? If a lot of institutions will not allow someone to access that. So we've put specifically in the wills and the Durham powers of attorney the right to access digital assets so that whoever's trying to help will have access to that information.
That's a good point.
Okay, now, your question is to how to make sure that we've got everything that's going to go smoothly. So one of the things that we have to take into account is the old bugaboo of Massachusetts estate taxes. As you're probably aware, or if you're not, Massachusetts has a threshold amount of $1 million. If your combined assets, and these are not assets that are subject to probate, these are all the assets that you have any kind of ownership in. If the combined assets go up and over the top of $1 million, then you're going to pay estate taxes to Massachusetts as it stands.
But that's changing in the future, right? It's going up, is it not? Is it not?
Well,
Did I not read that?
well, yes, you did, and so we don't know. So I'll give you a little history on that one. Last year, Charlie Baker, in his final budget request, proposed doubling that amount to $2 million and only taxing the amount over $2 million. Whereas the current one says if you go over $1 million, we go down to $1 and start taxing, which is grossly unfair. It passed with flying, well, not with flying colors, but after debate, it passed through the Massachusetts Senate, and it got to the House. And then they discovered that little statute that said if there's a surplus of assets, the state is required to return them back to the taxpayers. And so they said, geez, if we're going to return a lot of this surplus money, then does it make sense for us to give tax cuts, one of which is the cut in the estate tax? And so the Massachusetts House said, no, we're not going to do that. And so what everybody was counting on, which is doubling the threshold from $1 million to $2 million, didn't happen last year. This year, when Governor Healy, our new governor, sent her budget proposal to the State House, she requested $3 million threshold. What's been kicked around by the Senate and the House is $2 million. And again, the Senate seems pretty much on board with that. And the House was leaning in that direction, but revenues were down remarkably in April. And now they're taking a conservative review of the situation to see if it still makes sense to give any of the tax cuts, not only estate tax, but there were other tax cuts that were proposed. And can you do that when revenues are projected to go down? And we don't know the answer to that.
I see.
Will they raise the threshold? Boy, I sure hope so, because it was originally designed to catch the well-to-do. But since 2007, the threshold amount rather, has stayed at 1 million. And we've had plenty of inflation since that time. And anybody who lives in Upton has a house that's worth at least $500,000 or $600,000. And if you have a 401k or an IRA and some life insurance, you're basically there. And if you have a lot of any one of those things, whether you have a very big house or you have a lot in your 401k or your IRA or your life insurance is worth a whole lot, you're way over $1 million. And you're definitely going to end up paying estate tax. Well, one of the things we do in our trust is we put in provisions in the trust to say how to treat assets that come in so as to maximize the benefits we can get. Our current system, which is totally different than the federal system, is that if I have $1 million that I can shelter from estate tax, and my wife has $1 million that she can shelter from estate tax, and I have what we call a mom and pop will, I say I give everything to my wife, and I haven't given anything to anyone else, I had the ability to shelter $1 million, but I didn't shelter anything. And so my wife doesn't pick up my $1 million and add it to her $1 million to get to $2 million. My wife still only has $1 million that she can shelter. And if she lives in Upton and she's got a nice house and some life insurance and some nice cars and maybe a big 401k, or she got my 401k, or we each have a 401k and we're way over $1 million, she's going to pay estate taxes. Whereas if she used the clauses in the trust and didn't give everything directly to the spouse but put it in trust for the possible benefit of the spouse, now we can shelter $2 million from estate taxes, which we couldn't do if you had a mom and pop will that said, I give everything to my spouse. There's a major reason for using trust.
What percent is the estate tax?
It's on a sliding scale, and it goes from 6 to 16%. So it's not like the federal where it's going to just walk away and take a huge chunk. But that's, that can be pretty significant if you're looking at $50,000, $60,000, $70,000 of estate tax. That's a pretty significant chunk of your assets that instead of going to your kids are going to go to the state. And that can all be avoided by just proper language in a trust.
So does the trust affect the federal estate tax at all?
It can, but remember, the federal threshold this year is $12,920,000. So if your assets are less than $12,920,000, you probably don't have to worry about it. And if you're a married couple, as opposed to Massachusetts, if you don't use up all your $12 million exemption, you can tack it on, your spouse can tack it on to his or hers. So effectively, as a married couple, you can shelter almost 24 million, over 24 million, almost 26 million. So I dare say the typical person who lives in Upton doesn't have $26 million, and they're not worried about federal estate tax.
It's good to know.
But Massachusetts, yes, because the current threshold is $1 million, and we're on our knees begging and praying that it goes to $2 million, but we don't know if it will.
Can I ask another question?
Absolutely, sure.
So I have friends and neighbors who put their property in the trust.
Yes.
And you mentioned this very early on about you still control it, but it's still in the trust.
Yep.
So how does that work? And can you still control it, or does the trust control it, or does your trustee control? How does that all kind of work?
So there's two types of trust that we want to talk about, a revocable trust and an irrevocable trust. So first I'm going to talk about the revocable, because that's what most people have. And that's the one that's designed to make it a little bit easier to settle things and make it a little bit quicker and give you maybe some privacy. That's our revocable trust. So the typical couple who sets up a revocable trust is the husband and the wife, and they make themselves the trustee of that revocable trust. And the property is then transferred from husband and wife as two individuals to husband and wife as trustees of the revocable trust. That gets it out of the probate process and makes it quicker and easier and more private and all that sort of stuff. What it doesn't do is shelter it from nursing home bills. And that's a concern that a lot of my clients express when they come in to talk to me about estate planning in general. Geez, we worked really, really hard. We had a somewhat frugal lifestyle because we wanted to make sure that in the end there were assets available for our kids. How can we reserve those assets for our kids and not lose them if, because of health reasons, we have to go into a nursing home? Well, so in a lot of cases what we do is we set up an irrevocable trust. And here's how that works. My clients, the husband and wife, are the people who set it up. So they're called the donors or the grantors or the trustors. There's all sorts of fancy terms, but they're the ones who set it up. And they name one or more of their children, typically this is how it's done, as the trustee. The irrevocable trust is what it's a fancy term that the accountants use. It's an intentionally defective, interest-only grantor trust. Whew, that's a mouthful. What the heck does that mean?
That's what I was wondering.
So what it means is that the trust, if it has cash in it, and for an awful lot of my clients, they put their house in and that's it, nothing else goes in. But if it has cash in it, then any interest that's earned on that, interest, dividends, whatever, that gets paid to my clients. So if you are living on investment income and you put those investments in your trust, you will continue to get that investment income. You haven't given up the right to get that income. If you sell your house and you move in with one of your kids, and we now have $500,000, $600,000 that's sitting in your trust, that gets invested and the interest income comes to you. So you haven't given up any of your income when you're putting an asset in that irrevocable trust. Now, what if it's your house that you're putting in? Okay, you're putting in your house. Because it's an incomplete gift, that's part of this accountant type discussion here, but it's an incomplete gift, you still have the right to live there, as long as you want. You also have the obligation to pay the bills. So when the tax bill comes in, that's your obligation. If you need a new roof, you pay for it. If the plumbing is giving you fits and it's time to replace the hot water heater, you call the plumber and you pay it. This is not something that the trustee has to pay. You're going to pay it because you have all the rights associated with that house. Now, you decide, hey, we hate winters in Upton. We're going to Florida. If you put your house in the trust, does that prohibit you from going to Florida? No, it does not. The trust sells the house. The trust gets $500,000 or $600,000. The trustee goes down to Florida, probably by telephone, finds the place that you want to buy down there, and the trustee buys it for you. No money ever came out of the trust, so it's still sheltered in the trust. And it's not available to pay nursing home bills because it's still sheltered. So you're not stuck in your house if you put it in an irrevocable trust. The only thing you can't do is either cash it in and put the money in your back pocket or borrow against it. And the borrowing against it is a biggie. So I have a lot of clients who put their house into an irrevocable trust. And they used to come back to me, no longer, because I've learned my lesson the hard way. And they used to come back and say, geez, we went down to the bank, we wanted to get an equity line of credit. And the bank said, well, we don't loan to trusts. We only loan to individuals. And does that mean because I put my house in this irrevocable trust that I can't get I can't get an equity line of credit? Yes, that's exactly what it means. Unless we want to dissolve the trust, let you get your equity line of credit, put it back in the trust, and start again. Now, the starting again is the troublesome part of that, because when you're sheltering your assets, they have to be in this trust for 5 years before you apply to the state to pay your nursing home bills. If you get an equity line of credit, you've lost the sheltering that you've done so far, and you have to start again with a new 5-year time frame. Maybe that's not a big deal if you're in your 50s or 60s. If you're in your 80s and you got to start a new 5-year time frame, that's risky. It might or might not work. So if you foresee yourself needing to either refinance your current mortgage or getting an equity line of credit, do it first, and then go to see your attorney, and then put it in the irrevocable trust. Don't do it ahead of time. Don't do the trust ahead of time. Do the equity line of credit or the refinance of your mortgage. If you have a mortgage on your house, a lot of people do. If you have a mortgage, you can still put your house into the irrevocable trust with the mortgage still on it, and you continue to pay the mortgage payments. So that you don't have to wait until you pay off your mortgage before you put your house in an irrevocable trust. So it's a pretty good deal. Now, who shouldn't do it? Someone whose asset picture is zero except for their house. It's risky business. There is a way to get money out of an irrevocable trust, but it's complicated. If you do it wrong, the trust gets blown up, it doesn't protect anything, and you've wasted your time and your legal fees by doing that. There is a way for your children to get money out if you need it in a hurry. If you've got kids who are, you don't know if they'll do the right thing, they're not very sophisticated in legal matters, it's risky. So at that point, I have to go through some of the risks with the clients, just make sure they understand that this is not something that it's for everybody. It's not. And I talk a lot of clients out of doing these irrevocable trusts. They come in and, yes, sir, this is like sliced bread. It's the best thing since sliced bread, and I want one. By the time I give them some of the pros and cons, they say, maybe it's not a good idea. So it's not for everybody. You've got to have kids who are going to be able to follow very specific directions on how to get money out of the trust, or you've got to have some money set aside other than what's in the trust. Otherwise, it doesn't work. That's very important. If you have a combined asset picture that's, let's say, arbitrarily $2 million, $3 million, something like that, you don't need a trust to shelter your assets, because you've got so many assets that even if the state takes, or the nursing home takes a couple of years worth of payments, there's still gobs of money left for your kids. So most of the people who lecture on this topic say, don't worry about it if you've got a whole lot of assets stashed away. Your kids will not curse you if you have a couple of years in a nursing home. Some people buy that and some people don't. One of the assets you have to be awfully careful about in putting it into an irrevocable trust is your 401k or your IRA. If it's in a trust, you could potentially lose the stretch ability that you have with a 401k or an IRA. If you put your 401k, the beneficiary is your husband, and you die, your husband can take those payments out over a really long, extended period of time. If it's payable to a trust, or if it's owned by the trust, well, actually it can't be owned by the trust, but it could potentially be payable to the trust. So if it's put on a, if you have your 401k payable to the trust, and the wording isn't just absolutely perfect in the trust, it could be immediately taxable. Well, imagine if you had, say, $600,000 in your 401k, you had a really nice one, $600,000. You didn't word it properly, and you had it payable to the trust. Taxable immediately. It makes me so nervous when dealing with 401ks and IRAs that I'm queasy about shuffling them around. The other problem you have is you really can't put an IRA into the trust. The only way you can do it is to cash it in. Well, instantly taxable. If you're retiring on $80,000, $90,000 a year income, if you're lucky, and maybe you're only on $40,000 or $50,000 a year income, if you're a typical person, but you're lucky, you put several $100,000 into an IRA, and then you want to move that into your irrevocable trust, you got to cash it in first. Well, say it's a $300,000 IRA. You had $40,000 in income. Now you got $340,000 in income. You're in the highest tax bracket because you tried to shelter that. That's risky. So if you have a huge IRA or 401k, you need to work closely with your CPA to see how you can bleed money out of that with the minimum tax repercussions. But you sure don't want to just say, hey, Mr. CPA or Madam CPA, I just opened up an irrevocable trust. I'm going to put that in there because your CPA is probably going to jump across the table and throttle you and say, what are you thinking? You can't do that. So it's not for everybody. It's not a panacea, but it works well for a lot of people. So if you have a revocable trust, you want that because your house is in the revocable trust to make it smoother and easier and get you some privacy.
So on that point, besides the obvious revocable, irrevocable, what are the differences between the two besides just that not one you can't change?
The revocable trust, you have complete control over every aspect of that trust. You can rewrite the trust every day for the rest of your life if you want. It's no big deal. And you're not trying to shelter something. So you're not worried about breaking the trust by taking a wrong step. You can change the trustee as often as you want. You can change the beneficiaries as often as you want. With an irrevocable trust, there's only a couple things you can change. One is the trustee. You could change the trustee. The other is you've probably set your irrevocable trust up to say this is for the benefit of my kids. And if a black sheep arises, then what you could do is you could change the beneficiary designation inside your irrevocable trust to exclude the black sheep. But you have so much more flexibility with the regular revocable trust. And you're not looking over your shoulder and saying, did I just goof? Did I just break this? Because your idea is not to shelter assets. It's to just make it smoother and easier for the kids. That's all. But if you think you're going to get an equity line of credit at some point in the future, or you think you're going to want to refinance your mortgage because it's not paid off yet, you certainly wouldn't do it in today's economy because interest rates are ridiculously high compared to what they were just a couple of years ago. But when the interest rates come back down, if it's in a trust, the only way you can refinance at that point is to pull it out of the trust, which is a deed to you. Then you get the mortgage. You record all that stuff. Then you deed it back into the trust. So you're paying 2 recording fees and some legal fees to do all that. Do it ahead of time before you put it in the trust. Get it out of the way. It's much cheaper and much less stressful.
Another question, if I may?
Sure.
So many of us here on, what is that station, News Radio?
Yeah.
What is it, WH?
WH.
Commonwealth Advisory Group always advertises constantly about preserving your assets. If if you have to go in a nursing home in 5 years and
Yep.
that, could you talk a little bit, you've already mentioned that. Is there anything else, other information on that besides what you've mentioned?
That's basically what they're doing, is they're doing the irrevocable trust. And they're trying to shelter assets so that after the assets are in the trust for 5 years, they're off limits to the nursing home, and those assets have been preserved for the benefit of typically your children. Sometimes, if you have no kids, maybe niece or nephew or something like that. That's what they're talking about. Then they're talking, recently they've been talking about a blended trust. And what they're talking about there is incorporating estate planning with sheltering assets. So you get both at the same time, which can be done. It's not a big deal. So that I think that's what they're talking about in all those ads.
I see.
So, and as a comment on trust, I think this ties into something that you might have said earlier. Back in, say, the 1950s or 60s, if your last name wasn't Rockefeller or Kennedy or Romney or something like that, you didn't have a trust. Only rich people had trusts. And they were all set up by State Street lawyers, and they're all run by State Street lawyers, and you had to have a lot of money to do it. The common ordinary citizen today has a trust. Everybody's comfortable with them. Everybody accepts them. It's no big deal.
So if you have an investment portfolio
Yep.
and you put it into a trust,
Yep.
or you put it into an irrevocable trust,
Okay.
do you have access to it?
So if it's in a regular trust, it's a revocable trust, you're the trustee, so absolutely you have as much access as you want. You can wheel and deal with it and reinvest it and change the type of investment. You can take money out, you can reinvest it, you can put it back in. You have complete control if it's a revocable trust. If it's an irrevocable trust, you get the income that it generates, but you don't get anything else. If you get something else, you've violated the terms of that trust, and the sheltering that you did, the whole purpose of that, to shelter assets, is up in smoke. You've just ruined it.
So the regular trust then is protected, it's better than putting your assets into an estate, which can be looked at upon your passing.
No privacy if they're individually owned and they eventually go through the probate process, and we have to look at your will to see who gets them. That's right. You've lost privacy.
So it's better than that, but it's not quite as protected as irrevocable.
Correct. A revocable trust, and that's a big fallacy that a lot of people have. Oh, my house is in a revocable trust, therefore it's sheltered against possible nursing home bills in the future. That's completely not true. Absolutely not true.
So say that again?
If you put your house, as an example, the house, but it could be your investments, in a revocable trust, you can't brag to your neighbors, hey, I put my house and my investments in a revocable trust, so that's protected against nursing home bills. No, it's not. Not with a revocable trust, only with an irrevocable trust. And only if it's worded just so. I mean, there's tons of litigation over those over the course of the years. And those of us who do a lot of these have kind of followed the litigation and changed so that we don't violate what Judge so-and-so thought was a problem with these trusts. So,
If you have an irrevocable trust, and then at some later date and time you go to put your house into it, does it restart the cycling process if you later put something in at a later
Yes.
date? It starts the time clock all over again?
yes. So, well, yes and no. So today, in 2023, I put my house in this irrevocable trust. I don't put anything else in. In 2033, my daughter taps me on the shoulder and says, Dad, you've got some investments. Why don't you put those in your irrevocable trust to protect them? Well, I guess I didn't think of it. Can you do it now? Yes. I put it in 2033. Those investments have their own 5-year look back. But the house I put in 2023, that's been fully protected since 2028.
Same trust.
Same trust. Each asset that goes in has its own time clock. But you can continue to put assets in as you so choose. Yeah, it's not all or nothing today, or else we have to do a brand new trust in the future if we're going to put other assets to shelter them. No, you can keep putting assets in, but just each one has its own time clock. Other questions?
I think you've answered all my questions.
Okay.
Thank you.
So if I could summarize quickly, I love trusts. They're pretty common. They're well accepted by banks, investment houses, whatever. I think most people benefit from having a trust. Not everybody. I would recommend that people talk to their attorney about a trust if you don't have one already. I would recommend that you start moving assets into your trust if you have a trust but you haven't started to put assets in. If you're worried about nursing homes, I would recommend an irrevocable trust, or talk to someone about the pros and cons of an irrevocable trust as opposed to a revocable trust. And I forgot one very important thing that it's shame on me, but I do want to bring this up. I have a trust that says split everything between my 3 children. And we have bad luck in our family. And we don't have a black sheep. We have a deceased child. But that deceased child had children of her own. And those kids are 10, 12, and 15 years old. And my trust says, I have a pie, and there are 3 pieces in my pie. And my 2 living children are each going to get their piece of the pie shortly after I die. The 3rd piece of the pie was going to go to my other daughter, but she's deceased. I can't go to her. And I don't want it to go to her estate and go through all the probate nonsense. So I'm going to make it payable, and I don't want it to go to her husband because I thought he was a first-class bone. I love my daughter, I love my grandchildren, but my husband, and you should see the sleaze that he wants to marry now. Oh my God. So I want those assets to go to my grandchildren. I put language in my trust that says it goes 3 pieces of the pie, and if my daughter dies before I do, and she has kids, it goes to her kids. Well, if you were 22 years old and someone said, here's a couple $100,000, at least, maybe not a girl, but if you're a boy, wouldn't you be looking around to see if you could find a hot car? And wouldn't you be trying to impress all the girls by wining and dining them, taking them out to fancy restaurants and showing them what a hot ticket you are? And wouldn't you be broke around age 23? So I usually recommend trust language to take care of that situation and say if kids are not of legal age, 18, if they're not of that age, the assets stay in the trust. And for almost all of my clients, they stay in a whole lot later than 18 to protect the kids against themselves. These are the grandchildren now, to protect the grandchildren against themselves for what stupid things they might do if they get a whole lot of money. So that's an important point. I forgot to bring that up. But that's another reason why you want to have trust language in your documents. Take care of your grandchildren.
Can trust language ever be changed after you pass away?
No.
No.
Because you're the person who set that trust up. It's locked in stone. Now, if you and your husband set it up and your husband dies, the language probably says either one of us can change this. Yeah, so now you can change it. So if you get the black sheep, you can change it.
I guess I'm thinking of a particular situation where a woman came from a wealthy family, and the family set up a big trust with distributions to all the children and grandchildren, and they put a timing in disbursements.
Yep.
Not quite sure. And then, of course, they passed away. And this particular woman came into some bad times and had some serious health problems. But she couldn't get access to more than her share, and it was on a 5-year cycle.
Yep.
And even her brothers and sisters felt poorly that, they, rather than them taking their current money and supporting the sister, they thought, gee, look at this trust fund. If we could just rewrite it to have mom and dad would want her to get this money in this ill time that she's having. Nothing happened. No.
You can't, you're deceased, and you're the only one that can revise the trust. The trustee is obligated to follow the dictates of the trust. And if the trustee says, oh, I feel so bad for this poor person who's just having a rough go of it, and the whole family's on board, we'll just, make an exception. The trustee does so at her or his peril. Because if someone later on says, geez, I should have got, my dad was a beneficiary of this trust, and it clearly said that if he died, I would get the money that was supposed to come to him every 5 years. And so I'm his only child, and so I should be getting that. You gave money away from the trust. You gave it to Aunt Tilly, and that's not fair. You should have saved it, and the trust specifically said you should save it. I'm suing you. Well, as a trustee, you don't want to be sued. So you have to follow what's in the trust. And it's risky business if you don't.
So you mentioned just in the last conversation that if it's an irrevocable trust and one of the spouses dies, the other one can change the trust?
Nope.
No one can change it.
No one can change it. You can change the trustee. So if you've named your oldest daughter as the trustee, and your oldest daughter becomes drug addicted and alcoholic, she has a mental breakdown because her marriage goes kerflooey and she can't handle life, you say, well, she's no longer a good choice. You can change the trustee.
That's it.
You can change the disposition of assets you say, this trust is for the benefit of, quote, my children or my family members or whatever. You can change the disposition to exclude the black sheep or to exclude your favorite child who's a multi-billionaire and doesn't need a nickel and give it to the other kids who are common, ordinary folks who can use the money. You can change that, but that's about all you can change in that trust. It's irrevocable, and it's designed that way. Because if I could change the trust, then I could say, well, you know what? If I give money to Billy over here, Billy said that he would pay the nursing home. Because I haven't made my 5 years yet. So I'm going to give some money to Billy, and Billy will pay the nursing home. No, Billy's not part of the group that was originally supposed to get it. You're violating the terms of the trust. It's not going to shelter assets because you didn't do what the trust said. That's a no-no. No, you can't do that. So you have to exercise a little care in setting up the trust. If it's revocable, you can, as I said, you can change it every day of the week if you want. No big deal. If it's irrevocable, set it up with a lot of care before you set it up. Most likely it's going to be to benefit family members, and most likely you're going to have clauses in there that take care of the situation. What happens if a family member predeceases me or predeceases the date the money is distributed? So a well-drafted document will have that in it. And you don't name yourself as a trustee. I saw one the other day drawn up by a different attorney who named his clients as their own trustee on an irrevocable trust, and I just said, oh. I've had that happen in the past, and people have ruined the trust by just taking money out of it. They thought, oh, I'm the trustee, I can take money out. Oh, no, you just ruined what you're trying to shelter for your kids. No, you can't do that. So, exercise some caution.
And life insurance policies in trusts.
All right, so are you talking about the trust owning the life insurance policy, or are you talking about the trust paying the benefit to a trust? I'm sorry, the life insurance paying the benefit to the trust when you die?
It's a policy, would be, I guess, a policy. What if you put a policy in a trust?
All right, so you want the trust to own the policy?
Yeah.
Okay.
And should it be revocable or irrevocable?
You can do that, and there is something called a crummy. And it sounds funny that lawyers use something called a crummy trust. But it was actually named because of, and I don't know the guy's first name, James Crummy or something like that, who set up a trust, and the trust ended up owning the life insurance policy, and then it wasn't part of his otherwise asset picture for estate tax purposes. We do have a trust like that. They're not used often, but we do have those. You would do that if you're certain you're going to have estate taxes you have to pay. And then that will get whatever the value of that life insurance out of the picture for estate tax purposes. More typical is that the beneficiary on your trust, beneficiary on your life insurance is your trust. If it's the revocable trust, you change it as often as you want, it's no big deal. If you have an irrevocable trust and you want to, you don't have to shelter those assets. Well, you do. Life insurance, if it's whole life, the cash surrender value is an asset that you have to declare in determining whether or not you qualify to have the state pay your nursing home bills. So you'd have to actually change the ownership to put it, have the trust own it. And there's tax implications to that, which is beyond the scope of what we're talking about today. You could make it payable to your irrevocable trust, not because you're trying to shelter it anymore, but because the irrevocable trust says who gets what, under what terms and circumstances. So yes, you can do that. Yeah, that works.
Complicated.
So I guess you have to have a little give and take. Is an irrevocable trust something that makes sense for me, or is just a regular trust something that makes sense for me? Or is a revocable trust something that makes sense for me today, but maybe 10 years from now I might want to re-examine the situation. Maybe then an irrevocable trust would be what I want. I don't need it yet, but I'm kind of thinking about that. Maybe 10 years from now it might make sense for me. Great. That's a lot of give and take on that, pros and cons, and you got to go through all that stuff in your particular situation to see what makes sense for you, because it's not, at least it shouldn't be cookie cutter. Everybody gets this. No, that's not the way to do it. You should understand what you're getting into and whether it's good for you or dangerous for you and what makes sense. Okay. All right, well, I appreciate everybody's attention.
Thank you.
Great
Thank you so
questions.
much.
Thank you so much.
Thank you so
Appreciate
much.
that.
The information.
All right.